What's up, everybody? My name is Mike Sharp. This is Sharp Investing, and I'm going to talk about StoneCo. I have not done a video for a while on StoneCo, and the reason is it's a bit of a boring company now. I still own it, and I'm going to give you my sort of 2027 price target later in the video. But first, I want to say this is not investing advice. You should do your own research and do not invest on YouTube videos. That is not smart. Anyway, here we go. So this company, I know a lot of you follow StoneCo. I get messages saying, hey, can you do a video after all the releases? And I've just been busy, and I thought, this company is basically, they're just executing now, right? There's not a lot to talk about. There's some little things which I'll go into, and maybe actually one big shift in terms of how I'm looking at this company, but really, they're just executing. They're kind of a boring bank now, as opposed to a fintech company that they used to be. A high-flying fintech, NASDAQ, Cathy Wood kind of company, and now they're just a Brazilian bank with good return on equity, good growth, good customer growth, executing, doing buybacks. Like, it's just, we just have to let them cook now, right? So we're waiting for Pedro Zinner and co. just to execute the business plan. So, like just some high level stuff. I talked about them being a bank now. Their return on equity is 27%, right, in Q1, which is really high. If you're a bank investor, like that's a very good number. And then if you add in, 36% EPS growth year over year, you can see it's a pretty interesting opportunity, right? And the only problem is that it's in Brazil and they have, a crazy currency, which I'll go into in a bit here. The big shift that I'm talking about now in terms of how I'm looking at this, now we've gone from a fintech to a bank, but really how I'm looking at this is these guys are, to quote Manish Pabray, they're an Uber Cannibal now, right? They recently bought back 2.4 billion of their stock, and this is reais, this isn't USD. They've announced another 2 billion, which is, that's a lot. They also said they have 3 billion in excess capital that they plan to release to shareholders. They didn't say how, but it seems like Pedro is pretty good at just figuring out when to do the buybacks. Now I assume if the stock price went up quite a lot, and it wasn't such an obvious deal, we might get a dividend. But as long as it's trading at 10 times earnings with very high growth rate, we're probably going to see buybacks, right? So excess capital of 3 billion, they said they're going to release over time, and now they've sold links as well, so that adds another 3 billion in capital for them to do something with. And if you just translate that back roughly into USD, it's about $1 billion in buybacks, which is about 30% of the float at this moment on July 26th, 2025, with a market cap around 3.6 billion. And then if you add on top of that, so 30% of the stock they're probably going to buy back over the next, up to 30%. I would say they're going to do most of that as buybacks. But then you also have the earnings going forward, which they don't seem like they have a lot of use for right now. So maybe another 400 million USD in earnings that can be used towards buybacks. That would be another 11%, right? So you can see right there, if they maxed everything out this year, they could get up to over 40% of the float being bought back, assuming the stock price doesn't fly from here. So I'm looking at these guys as they're just growing, they're cannibal. That's what we expect. Great. If it hits my price target by 2025 or earlier, I'll sell most of it and keep a little bit. But for now, I got no problem. The good thing about buybacks too is it puts a floor under the stock a little bit, right? So if the stock price goes down, as shareholders, we're like, oh, actually that's good, because now they can plow money in and buy a whole bunch of shares back, and the EPS for us as existing shareholders goes up. So price up, good. Price down, also good, as long as we're willing to hold. And I am. So now I want to go back a bit. Like, this is, if you've been in the stock for a while, there's been some wild price movements. Stock price up big at the end of 2023, stock price down big in 2024, and then up until just a few weeks ago, stock price way up in 2025. It's like down 50% 2024, up 100% in 2025. Like it's pretty wild. And I just want to talk a little bit about why I think that is. The obvious one is the real, the reais, the currency. If you overlay the BRL to USD with the stock price, you'll see that it really does move really close to the currency fluctuations. And the reason we're having those big moves is, it's normal. It's Brazil. We have Lula in there who doesn't seem to care about his fiscal policy that much, right? He just spend whatever he wants, and ignore sort of the implications of that. We also have on the other side, usually the US is a bit more stable. Now we have Trump in there throwing huge wrenches into the system every day, right? So, and I do think Trump long-term is USD negative, right? He wants the US dollar down, I believe. He hasn't said this outright. Scott Bessent has, actually, because, they want more exports. They want more money coming into the US. And the only way they can export their stuff to a higher level is, first of all, is these trade deals that they're trying to work on. And the other one is to get the US dollar down, right? Before, when you're just importing everything and exporting your manufacturing base, strong USD is good, but based on Trump's behaviors, I think he wants the US dollar down. And also, if you look at this big, beautiful bill, this is a crazy spending bill. It's a headwind for the US dollar. And, we might get bounces up, but I think long-term the trend is down. So countries like Brazil might actually be good in these scenarios. Like you've seen what happens when the BRL goes down. I think it was down 10%, or it was up 10% since the beginning of the year. And that's basically doubled StoneCo. So that's the big one going forward. It's going to be wild. We're dealing with emerging market and Trump at the same time. Expect chaos. And just, it can create a situation where you can buy strategically and sell strategically into strength or weakness. So there's that. I do think there's also 2024 was a bit of a mess, because if you think of who owns this stock, like I was saying before, there was a big turnover I believe there's a big turnover in the shareholder base. A lot of people bought in because this was a NASDAQ darling, high-flying fintech, and now it's just an emerging markets bank that don't really have the same group of interest, right? So there's a lot of turnover from these people to these people, right? And it's taken a while for the bank investors to start moving in. Now, the other thing that I think has happened is if you see a company you're holding, let's say you're a hedge fund manager, and you've got StoneCo on the books in October last year, and it's down 40%, you're probably going to want to do a bit of window dressing, because if it's down at the end of the year showing 50%, minus 50%, and you've got this obscure company, your unit holders are like, what the hell are you doing buying this like weird Brazilian company and it's minus 50%? Do you even know what you're doing? So I think there's a lot of just getting it out of the portfolio in 2024, and then maybe the reverse of that in 2025 as stuff started to reverse. Because as we know, most of the market is momentum investing, right? It's bots and it's people who just want to buy stuff on the way up. And cheap value investors are the minority in terms of the volume on the stock market. Now let's just quickly go over the company results here. I'm going to look at Q1. Adjusted gross profit was up 19% year over year to 1.645 billion reais, and the EPS in reais was 197. That's adjusted. You can see that there's some operating leverage that's active here, where the EPS is up a lot more than the gross profit. So EPS is up 197, and the goal for the year is 8.6, which would translate at an exchange rate of 6 of about $1.43 in USD, right? We care about the USD number because most of us, I think, are based outside of Brazil. And so the thing that's actually going to move the stock is the USD results. So what I'm going to do is I'll be a bit conservative with the exchange rate at 6, and that's going to put it at forward earnings at 1.43. And you can see it's trading at about 9 times forward earnings. That's not cheap. But if you look at the growth rate of the business, forward if we look at the forward rate for till 2027, basically the company's saying they're expecting to compound earnings per share by 27%. So if you take the growth rate of 27% and look at the PE, you have a pretty strong PEG ratio, right? And that's I like the PEG ratio because it's a very simple way to see if it's cheap versus the growth being forecast, right? And that's a PEG of about 0.33, which is really cheap, actually. Again, you have a currency headwind, right? So the company has to grow faster than the currency depreciates, or else you're at zero, right? Or less, right? So let's say currency depreciates at 5%, company grows at 5%, your net USD return is zero, right? So we have to discount by that as well. So it's not a straight PEG ratio that we can use. So even if we take off 10% growth rate from that 27% compounded rate, you're still at a PEG ratio of 0.5, growth at 17, PE of 9. Still cheap, even accounting for the currency disaster that may or may not happen. They do say, that the TPV growth is 18%, and they say, one of the analysts pushed back on, are you actually losing share to the competition now? And they're basically saying, well, the concerns there are overstated. We're actually still taking share. We have to take their word for it, essentially. Or you can dig a lot more than I have and maybe figure that out. I'm not really concerned about that because I'm not going to be a 5-year holder of this business. I'm more of like a 2-year holder at this point. So they did warn, they said, prepare for a bit of a tough 2024 because interest rates are going against them. Interest rates were rising in Brazil, which gives them a bit of a headwind because their financial expenses then go up because their cost of funding goes up. I do think those are temporary problems, so I think we can probably ignore them. But if we see a little bit weaker results this year, maybe that's going to be part of the reason. They did talk. Now I'm just giving you little bits from the earnings call, but as I'm a bit all over the place. But PIX, they're talking about PIX, and if you don't know, PIX was a fear of a lot of foreign investors and for a long time. And basically, they're saying PIX doesn't displace our cards business, right? The cards business is their bread and butter. They basically say PIX is a war on cash and it's a war on debit, right? So it's actually net positive for them, even though the margins and the take rate on PIX is lower. It's not at the expense of their cards business. That's a different type of customer. So PIX is actually good, and they keep reiterating this, but I just wanted to point it out. Customer growth numbers. Now, last year, if I'm remembering correctly, they basically said our customer growth isn't going to be very high going forward, and I think that put a scare into the market. But they're still growing at 17% year over year, right? It's actually still really healthy. I think it was 19% in Q4, so it's coming down, but 17% is a lot. When you factor in the EPS is actually multiples of that, right? Because every customer you have, maybe they'll come on with one product, payments, and then they'll add banking, or they'll add credit, or ideally both, and maybe credit cards, and you end up with this sort of multiplier effect, right? So I do think there's still a lot of juice in the tank left on growth here, because the leading indicator, the customer number, is still really healthy. Now, this won't happen forever because there's only a limited number of customers, merchants in Brazil, and it's pretty. There's a lot of strong competition in here. There's Meli, and then there's Pags, and they both offer good products, right? So expect that this will go away. But for now, it's actually a nice little bonus that it's still going. They talked about the cash sweep strategy, which is basically taking cash out of current accounts and putting into time deposits, which helps them with their cost of funding a little bit. So that's a small margin helper going forward. They've moved a lot of money across into these term deposits, so that's a good move. Banking clients up 36% now, and that is up to about 3/4 of their overall client base. So those numbers will also stop going up that fast because you can't have more banking customers than you have customers. Ideally, they'll get close to 100%, and then it'll just stay there. But right now, it's showing that they have a, you know, a good offering that is getting people to use more than one product, and banking is sort of an indicator of that. I don't remember the deposit numbers, but deposit numbers are a bit tricky to watch. They're not really that useful because when interest rates go up, deposits go up, but then when interest rates come down, deposits will come out as well. So we're just looking at banking clients, which as the key number. For costs, now if I go over this income statement here, if I can find it, one of the concerns I have here is the selling expenses, right? You can see that from last quarter, their selling expenses have gone up almost 50 million. And from last year, they've gone up 63 million. And so they told us last year, it was just this one-off spike in selling costs, that they were doing this. They were doing a advertising campaign on some TV show there. But really, this is just, it hasn't stopped, right? So if we're looking at the operating leverage, they really focus on their administrative expenses and how they're managing those. But really, if we're looking at the selling expenses that they need to grow this customer base, they're not out of control, but they're hurting the operating leverage, and they're more than twice the level of the admin expenses. So I'm surprised they don't focus on it a bit more in terms of what they're doing here and what the future looks like, because I guess I just have a concern that those are not well controlled. Anyway, but the bottom line is, if we look at the net income for the period, the margin is up from 14.6 last year to 15.1%. We can't really compare it to quarter four because that's the Christmas period, which is sort of an anomaly period where there's more spending and more activity. So net income margin has gone up slightly, but it has stopped going up dramatically like it did for a couple of years there. You can see if we go back up to the adjusted gross profit line, that's actually gone down by 0.1%. But if we look up a bit, that's mostly due to the financial expenses, which I talked about, which are a result of the interest rates. So anyway, I'm going to keep an eye on cost and margins and stuff like that, because obviously it's important when we're now in the sort of a little bit more mature phase of the business, where the growth is slowing down a bit, and we need to manage all the little bits a bit better. Okay, so credit, here's the big winner. Credit cards, they've added credit cards, and these are growing very fast, 41% quarter over quarter. Still small, but it's showing that there is demand for these, and these are high margin products that they're adding. Overall credit is up 20% quarter over quarter and almost 3x year over year. So this is the engine of their growth to 2027 with their guidance for 2027. Still looks really good. The NPLs are looking still strong. They say that it's behaving as expected. And basically, all we've got to do is hope they don't blow themselves up like they did already. Because if they do, that is the end of this thesis. The stock's going to go down and probably stay down for a while. So this is the only thing that probably can derail us. They do have a lot better handle on this stuff than they did last time. They actually have somebody running the credit segment this time. They have personal guarantees from all of their merchants so that they have recourse to collect if somebody doesn't pay, which they didn't have last time. So so that's all I'll say on credit. Now, if we go to the goals, their guidance for 2027 used to be 4.3 billion reais. That's what I was working off as an investor. I thought, okay, if they can get to 4.3, I'm happy, right? Because you reverse calculate that. Let's say it's a 7 BRL exchange rate. That gives you 600 million in net income, multiply it by 10 at minimum. You've got a 6 billion market cap, which is a lot higher than it is from here. If you get a 15 times multiple at any point, because you get some excitement in Brazil, then you're really laughing, because it would be a 9 billion market cap. But now they've changed their the way they're looking at the results, and I actually think this is a good change. Gross profit's the key here, and EPS, because they take into account that Uber Cannibal. The gross profit takes into account that they have sort of a diverse range of products now, where you can't really measure credit the same way you can with payments, where the income doesn't really make sense if you just lump them all together. So I think gross profit's the right way to go here. They're aiming at 10.2 billion reais in 2027. That would be a CAGR of 18%. And then if we look at the adjusted EPS goal of 15 reais, that would be a CAGR of 27%, like I said before. Now, if we use a 6.5 exchange rate or a 7 exchange rate, you're going to end up with a 2.14 USD in earnings in 2027, and maybe up to about a 230 EPS, right? So my price target is $25, and I think even if we use the low number there, $2.14, that's still trading at an 11.67 PE ratio in 2027. And I think that's still a great deal, given they're assuming a 27% CAGR rate. And again, if the price doesn't perform, you still have these buybacks in the background that are actually going to push EPS up further, right? Because the more they buy back, the higher that EPS is actually going to go, right? So bottom line is, as long as they execute and don't change these goals and say we're on target for hitting the goals, I'm going to hold this, right? If you gave me $25 now or next year, I'd probably take it and sell most of my shares, because I don't know what's happening after 2027. But at this point, I'm looking at it as, to again quote Manish Pabrai, looks like to me like an easy double from here at 13.25 or whatever it's trading at. So I'm just going to keep holding, and just if they keep executing, I'm going to keep holding. That's basically it. Everything looks good. Earnings are going to come out in a few weeks, and who knows what's going to happen. So I might not do a video after that, unless something interesting happens. But yeah, like for now, I'm just holding. Anyway, if you made it this far, thanks for watching. I appreciate it, and I will catch you in the next video.